estate planning point of view, you want to pay the least amount of estate duty and capital gains tax. So you would do that clearly by throwing your assets into trust, because the assets that lie in the trust are never brought into your estate for estate duty purposes. So that's what you end up doing. And certainly from a tax planning point of view, you're going to see just now how effectively that can work for you. So it's all about trust and its formation and its benefits and its family succession. Clearly the parties to a trust are generally the settlor, who is the founder of the trust. You have administrators to the trust, or the trustees who are the administrators of the trust. The beneficiaries are really the owners of the trust. And you have a trust deed that contains the rules, regulations and procedures that you have to follow in terms of that particular document. You have the Trust Property Control Act, which controls the registration of trust deeds, and that's quite important in South Africa because at least we have control. If you're going to form a trust, you must formally apply to the Master of the High Court. You've got to give them a copy of your trust deed, which they scrutinize, and they give you a letter of authority, which then allows you to then allow the trust to perform its functions and so on. You get many of the offshore trusts, they don't actually have any control. In other words, you don't register them, they call secretive trusts, you put in your letter of wishes and all of that. And again, we're going to talk about those kind of trusts. So certainly in South Africa we have some control. But remember, trusts are not governed by Companies Act. It's governed by the deed itself and by common law to some extent. So by and large you're going to find that financial institutions are afraid to deal with trusts. Why? Because they need to read your trust deed in detail and establish what is in your deed before they can even lend you money. And people then on that basis shy away, lenders and so on, from trusts. But trusts are still very effective and they are used pretty widely by high net worth individuals. Different forms of trust. You get the inter vivos trust, which you set up during your lifetime. You get a testamentary trust, which is set up in your will. And inter vivos, the word inter vivos in Latin means during your lifetime. Distribution of income and capital to beneficiaries. You can have discretionary trusts where the trustees decide how the distribution is going to be made between the beneficiaries. And that's also very important. They do it on an annual basis. It could be income, it could be capital, but they make the decision by majority vote. Hence it's best to have 3 trustees so that you could have this veto vote, or you may have 2 people going on one side and the other on the other. But at least if you have 2, you could have this conflict that could arise amongst trustees. So those are discretionary trusts where trustees exercise their discretion. On the other hand, you could have a vesting trust where you clearly state that I will get 30%, my wife will get 20%, my son will get 30%, my daughter will get 20%. So that would be called a vesting trust, where you stipulate in the deed exactly what percentages each person will get. We don't recommend those kind of trusts. They are inflexible. They often create issues in a family, so we don't generally advise vesting kind of trusts. So typically in a family trust, you have what we call a settlor, and I don't want to go into a debate about who the settlor should be. I would normally advise it must be an elderly person, so I call it the granny trust. Some people prefer not to do that, but I do it for a good reason in my ones. I generally don't always call it the granny, but I would say somebody elderly who forms it, because subsequently 10 or 15 years down the line, because a trust normally kicks off as the following. It says, for the love and affection of my family, I hereby create a trust and I donate 1,000 rand. And that's an important aspect of trust. If you don't have that donation, it's not a trust. So certainly the settlor plays quite an important role, and the idea is to have an elderly person, because 20 years later, if SARS comes back and says to you that this particular trust is a scheme that you set up, but you say, hold on, I didn't form the trust. It's my aunt who formed the trust for me. So these are, and some people may not agree with that, but that's what I would recommend that you do. As far as the trustees are concerned, it should be you and your spouse, ideally, and it must be an independent trustee. I've come across many trusts where you and the spouse are the trustees. In my view, those kind of trusts are going to have issues, I believe, as SARS gets tough and they start putting the screws on trusts. And why do I say that? Section 33D of the Estate Duty Act states that if the deceased is competent to dispose of property, then such property shall be deemed to be his or her for estate duty purposes. They haven't applied that section as yet, but I can tell you that they're going to put the screws on. What that clause really means, that if a husband and wife are trustees, are they not in a position to control that trust between themselves? And on that basis, you will find that they can take all the assets back. And the idea is that's not why you form trusts. The reason for you forming trust is to take the control away from yourself. And by putting in that independent trustee, you'll see we talk about the Badenhorst case, and there's a couple of cases that have happened in the last 5 or 8 years now, where the master's offices throughout the country insist that there be an independent trustee. What is the meaning of independent? It is independent of the beneficiaries. So that person is not a beneficiary of the trust, hence the word independent. So he's an independent trustee. But those trusts that have a husband and wife, which are still around, because those were probably formed prior to 2008, I think that's when they first introduced the independent trustee principle. If you actually do an amendment now, and if they come across the fact that there are only 2 trustees, they'll probably write to you and tell you, you must have an independent trustee in this trust. Okay, and the beneficiaries will be you, your spouse, your children, and your grandchildren, and as they come along, you can create sub-trusts for these children, and as they have their own children and so on, so you don't mix them up and have them all in one trust. The idea is to actually do that. And I think also what is very important, I've come across many trusts in practice where, for example, you set up a trust and you exclude yourself and your spouse as the beneficiaries. Now that's absolutely wrong. I don't know why people do that. They actually exclude themselves from that particular trust, and they put their children down as beneficiaries. That's not a good thing to do, because ultimately you live to the age of 80 and 90, and if you need money, I mean, you created this trust for generations to come, and when you need money, you got to go with a begging bowl. Although you could be a trustee of the trust, you got to go to the begging bowl to your children. And if your children believe you're not going to get the money, or they have to get the money themselves and lend it to you, and what does that mean? What have you done? You've destroyed yourself. So I think that you have to appoint yourself as a discretionary beneficiary of the trust. So you and your spouse have to be there. And don't end up in a situation where, if you actually do that, you have to be also a trustee. Because at the end of the day, don't put in clauses that whereby you have control over your trust. You must never have control, because then the 33D and Section 7s of the Income Tax Act, which talks about donation, settlement, and disposition, and the fact that you have control over your trust. You don't want to be attacked by those provisions. So you ideally must not have controlling provisions in your deed where you say you have the right of say, you can veto everybody else. Those are dangerous clauses that you're playing with, and you must not have those clauses in your trustee. Don't even have the situation where, for example, you don't select your trustees properly. For example, you and your spouse and your children and your grandchildren, or they haven't come as yet, your immediate family would be the beneficiaries. And then what would happen is that you choose your trustees. And how you choose your trustees is also important. So if you're choosing 3 trustees, you appoint yourself, you appoint your wife. Who is this 3rd trustee you're going to be appointing? It's important that you know the trustee who you're going to be appointing. We're going to talk about whether it has to be your accountant, your attorney, or your financial advisor. We'll talk about that. But I'm saying the 3rd trustee is terribly important. I'll give you a typical example. I had a client that saw me last year. He came to me. I didn't form the trust or anything like that. Who were the trustees? His family was the beneficiaries. It was him, his wife, his children. Who were the trustees? It was him, his wife, and his wife's brother. And he built a home in Umhlanga for 16 million rand, and he put it in the trust. And they were undergoing a divorce. And the wife kicked him out of the house. So he came to me and he said to me, look, I got this problem. The wife has kicked me out of the house. They gave me notice. The trustees took a decision, and I was there. They said that you're a beneficiary, you're a discretionary beneficiary of this trust. We're sorry, you have to leave the house and get stuffed. And this poor guy had to get stuffed. He was out. He built the house with his money. And there was obviously things, in other words, they had a bond on the house, he was paying the bond installments and so on. At the end of the day, the choice of your trustees are terribly important. If it's your good friend, just make sure that your good friend doesn't rush off with your wife. Then you're in serious trouble again. So these are the kind of things that you have to be careful about. Okay, so just to talk about the kind of things that are happening in terms of the type of trust that you can set up. Ideally, you must have one family trust. Some people set up like 5 and 10 and 15 trusts. I don't know what for. Your family trust must only be one trust. And the idea is that you put all your personal things in the trust. So anything that's going to grow in value that doesn't have a debt, the ideal situation, initially it may have a debt. But the idea is to clear the particular trust of all debt. It must not have any debt. It must be your personal thing. It must have, that's the trust you're going to rely upon during your lifetime to protect you, to protect some of your assets and so on. But you're going to be involved in a whole lot of business undertakings. Separate those with, if you are going to use, you ideally should use companies in combination with trusts, and this is what it's telling us here. You could have property trust, you could have share trust. There are different kinds of trusts that you can have. In the case of a property trust, that's regarded as a business trust. If you're investing in properties, then ideally, just looking at it, taking a couple of steps back, you should have a property commercial trust, and you should have a property residential trust, or what we call a residential property trust. The reason why I recommend you split the two is because in the case of residential trust, you don't have any VAT implications because you're getting rental income in the form of residential rental income. That's exempt supply from the VAT perspective. So clearly, when you're buying and if you were selling properties and so on, you don't want to have those VAT consequences that come upon you. From a commercial property point of view, yes, they are. You can zero rate sales. It's possible then to pay the VAT and claim the VAT back and so on. In residential property, generally, you can't do that. So by you separating those two transactions, you clearly can have them in separate situations. Then you also can create what we call share trusts. And you find that in the case of share trust, you've got share trust number 1, share trust number 2. If you have 5 or 6 different companies, you could then have 5 or 6 different share trusts. But you don't have to have so many share trusts. It's up to you to decide. Because the reason for my saying that you should ideally, for each company, you should have a separate share trust is because for some reason, if the company, the shareholders expect to sign surety, then it's the share trust that is going to sign surety. And ultimately, if something happens in the company 1, in my example here, all you do is collapse the share trust. Who's the beneficiary of the share trust? It can be your family trust. That's not a problem. You just collapse the share trust and everything falls away. You can't have a situation where company 1 has as its shareholder one family trust, because you have a whole lot of assets in the family trust. If you sign surety on behalf of company 1 by the family trust, then what happens? It has a domino effect in the family trust of all the assets. So you could lose all your assets in that family trust because you've signed surety and you find that your creditors and the liquidators are going to come after you in your family trust. So by doing it on this basis, what you're really doing, including this property trust that you are setting up, the beneficiary of your property trust can be, for example, your family trust. It could even be individuals as well, because something that is in the capital gains tax legislation is highly technical. I don't want to go into a lot of detail. But when you have 2 trusts, one on top of the other, there's certain CGT implications that could come around you where you're not allowed to distribute down to the beneficiaries. And this is when, remember, CGT legislation is the only 2001 legislation. They've been eyeing trusts, as you know, going way back 20 years now. And they've blocked something, which I would perhaps just briefly allude to in my presentation. Inter vivos trust. So from a structuring point of view, we're saying you have to do a proper structuring. So it's not as simple, you're a high net worth individual, form one trust, buy all your properties, put everything in the one. Ideally, that one family trust should have no debt, absolutely no debt. That's where you're aiming to go ultimately. Let all the debt lie in all these other ones, it doesn't really matter. Appointment of the independent trustee. The independent trustee should not be a beneficiary. We pointed that out. It must be at least one trustee as an independent trustee. And we have all these cases, the Parker case, the Badenhose case, the First National Bank, and the Brits case. All these are fairly recent cases. The role of the independent trustee, he need not be a professional person. Okay? In other words, he need not be the accountant, the lawyer, or the financial advisor. However, he has a fiduciary duty. He must have the skills, the experience, and the knowledge. He must attend meetings. He must not sign personal surety. No bank must make him sign personal surety. He's not allowed. Ideally, and many a times they do sign because they don't really know. All they get told, the bank is the trust is signing surety. And then you sign this document. The trust has signed. In addition, each trustee is signing as well. He is not signing. He is not supposed to be signing. But if you've signed, then you're in trouble. Just remember that, because the bank will use it against you. So you must not sign. If you're the independent trustee, You don't sign personal surety. Just coming back to this thing about trusteeship, I think it is quite an onerous kind of responsibility that is placed on the trustee. So if you're an independent trustee, it's quite important that you understand your role. How often do independent trustees just get requested to sign documents? Or, you know, we phone the independent trustee, we're sending somebody around, put your signature next to mine. Is it that simple? Remember, if you make reckless decisions as a trustee, you're going to get sued by the beneficiaries somewhere down the line. So it's very easy to say you're standing as the trustee, but it can affect you substantially because you could be held liable for making reckless decisions. And those kind of reckless decisions often come around if, for example, your beneficiaries are actually aggrieved that you went and bought the property when you knew that when you didn't even do a proper feasibility. Do you attend the meeting when they're buying a property for the trust? Do you attend the meeting? Let's have a look at the feasibility study. What is the rental income? What is the area like? Can we see some independent reports? How many of you sit as an independent trustee and look at that before you start signing all the documents? Okay, there are really two ways of adding assets to a trust. If you have those assets in your personal name, you can either donate those assets or you can sell the assets. If you're donating the assets, remember the 100,000 Rand donation per year between husband and wife applies, so that could be 200,000 Rand that you could donate to a trust. And it's actually amazing. I've had clients from way back from 1986 that have been making these kind of donations. At that time it was 20,000 Rand. They've increased it over a period of time. But I have many clients who've been making those kind of donations, and they've been making it every year, and then effectively investing their money in the name of the trust. And they have millions slashed away already based on the fact that it's moved away from the estate. So making use of this 100,000 Rand donation when you have a trust is crucial, and many people are still not making use of it. Assets donated into a trust, remember, has tax consequences if there's income flowing out of those assets that you've donated. Because Section 7 of the Income Tax Act talks about donation, settlement, or disposition, and as a result of which income flows to the beneficiaries of the trust. It has implications in your hands. It could be taxable because of the donation. It will be taxable in your hands, although it is deemed to accrue. I'm going to take the questions at the end, if you please don't mind. It could come around to actually bite you because you didn't consider Section 7. Assets sold to a trust. If you are selling assets in your name, for example, typically, let me say, if I've got an asset, let's say if I take a very simple example, I have an asset, it happens to be a commercial block of flats, it's worth R1 million, but I'm getting a very good return, 20% return out of the property. I then get a value put on the property, and perhaps on a return basis, that may sound high, but I'm still using the R1 million. That's the market value of the property. R1 million, I got a valuation done. I then sell my property to the trust. When I sell it to the trust, it arrives in the trust. You debit the property account. Who do you credit? You credit your loan account. So you have a loan account in that particular trust which has the property, and what do you have to do? You must charge interest on that loan account. At what rate? You charge interest at the rate of 7%, and you've cleared the hurdle of a donation. So you don't have a donation going forward, and you've done it at commercial rates. You've sold the property at a commercial rate. You've offered the trust to borrow the money from you. They must pay you a rate of 7%. So they pay you a rate of 7%. You're getting, if the asset is worth R1 million, you're getting a net return of 20%. What does that mean? You're getting 200,000 Rands a year. You then deduct the 7%, which gives you 70,000 Rands a year. It does become income in your hands. It's an expense in the hands of the trust. It's an income in your hands because that's the 70,000 interest on the loan account. You then have a 14%, 140,000 Rand. It's a perfectly commercial transaction. You've sold it at market value. You're charging interest on the loan account. You can take the 140,000 Rand and distribute it amongst your beneficiaries, your minor beneficiaries, and it's perfectly legitimate. You've avoided all the anti-avoidance provisions in the law, and that becomes income in the hands of the children. So often people get caught up with that transaction and they do it the wrong way. Okay, so certainly from a trust point of view, what are you looking for? You're looking for pegging your estate, and how do you do that? If you're buying a property in Sandton and the property is worth 2 million Rand, what you then do is don't buy it in your name, you buy it in the name of the trust. If you buy it in the name of the trust, the property is worth 2 million Rand, you sell it and 10 years later, you die, and the property is now worth 20 million rand. But because the asset is not in your name and you're a beneficiary, a discretionary beneficiary of the trust, that asset is not brought into your estate for estate duty purposes. So it's excluded from your estate. So that's what we call freezing the asset for estate duty purposes. It's not your asset, belongs to the trust. You're a discretionary beneficiary of the trust, hence it's not taxable in your hands. If you look at tax planning, certainly you can plan for your taxes. Gordon can stand on his head, but at this point in time, you can still plan your assets, your income in the following manner. Look at my example of selling that asset to the trust at market rates, charging interest on the loan account. I have income of 350,000 rand. If I decided to leave that income in the trust, I will pay 40% tax. And it's actually suicidal for you to do that. If I've got beneficiaries who are 1-year-old, 2-year-old, 3-year-old, 4-year-old, and 5-year-old, I make a distribution to those beneficiaries of the 140,000. In this case, it happens to be 350,000. I make that distribution to 5 of them. They each get 70,000 rand. Effectively, below the threshold, I pay no tax on that income. Their loan account is credited. The beneficiaries' loan accounts are being credited in the books of the trust. You're not physically going to give it to them. Effectively, you've saved yourself 140,000 rand. This is a very simple example. I can assure you in practice, people are saving millions of rands on this basis. Effectively, we're saying that only when SARS and the government changes the law and says we're not going to allow you this thing about the conduit pipe principle, which is in the Armstrong case and a whole lot of cases that we have, to say that the trust is a pipe through which income flows, that we're going to close the tap. You can continue to use this, provided you have all the anti-avoidance provisions, you've catered for it. Clearly the Section 7s in particular of the Income Tax Act, you clearly have saved yourself a lot of money. Also remember, the fact that you're crediting your beneficiary's loan account is actually quite important. You don't want to have a situation where you have this 1-year-old, 3-year-old, 4-year-old, etc. 10, 15, 20 years later, you have a big fat loan account in their name, and they come to the trustees and they demand. They say, you know what, you have a 15 million rand loan account in my name. I want my money. I need to buy a Lamborghini. Stuff you guys, I'm not interested in your planning, and so on. I need my money. You have a clause in a deed that says that the loan account will be paid at the discretion of the trustees. So whilst you make those kind of demands to the trustees, the demands need not pay. But further to that, I would advise you to even get your 1-year-old and 3-year-old and 5-year-old to pay you maintenance. So what you then do is debit the loan account in respect of the maintenance that they're paying you as part of your family. So for maintaining them, for going to school, for all of those things, when they get to varsity, you debit the loan account. It also helps you in your lifestyle questionnaire. It reduces your overall income. So, you know, if